Hi traders, this is MS Jaffrey, and we are here with a very extraordinary good strategy for the traders who are kept on losing their money and they are fed up of trading, so they can use this strategy and they can earn a lot of money from using this strategy. Before I explain this strategy, the most important thing is that the selection of the pairs, currency pairs which we're gonna use in this strategy. That I have jotted down 7 pairs. The first one is GBP USD. The average volatility of GBP USD per week is 265 pips average per week. The second pair is Euro New Zealand. Euro New Zealand has got the average volatility per week is 305 pips. Third pair with me is GBP Aussie, having average volatility of 281 pips per week. Fourth one is GBP CAD, average volatility of 273 pips per week. Number 5 is GBP Swiss franc, average volatility of 312 pips per week. The sixth one is GBP New Zealand dollar, average volatility of about 307 pips per week. And the seventh pair is Euro Aussie, having average volatility of 323 pips per week. Because this is very important, if you select good pairs of currency, that can give you a lot of money, because the higher the volatility, the higher the chances that you win the trade and you earn a lot of money. Now the second most important thing is that we choose the high probability setup in trading the low of the week and high of the week strategy. This strategy is dominantly utilized by the people running the hedge funds, the big financial institutions, the big banks in the world. They use this strategy and they earn a lot of money. Normal traders, the retail traders, they are unaware of this secret, which is very important. How the big banks are going to use this strategy, and they really make the market moves. Now in this strategy, the most important thing is that this strategy has got risk to reward ratio average 1:8 or 1:9. That means if you earn $7, so against that you may be able to lose only $1. So if you risk your capital by 1%, that means you can lose 1%, but you can gain 7% to 8% per trade. Now, after the risk and reward ratio, then we come towards the stop loss and the TPs. For those pairs having the average volatility between 220 to 250 pips, you can utilize stop loss between 30 to 35 pips only. And for those pairs having volatility above 280, 290 to about 320, 330, for those pairs you can utilize stop loss about 45 to 50 pips. In this manner you can really make your risk to reward ratio 1:8 to 1:7 average. So by utilizing this strategy, there are chances that you can win a lot of money, and you don't have to sit in front of the screen all the time, and the strategy has got 80% win ratio. This strategy has got 80% win ratio. Before that, I start with the strategy. There should be a disclaimer that anyone following this strategy, if he loses money because everyone has got different money management and they use different risk and reward ratios, but their per trade risk is different. So disclaimer is that this video is purely for the education purposes. So for any loss, the YouTube channel owner is not responsible. Now I start with the strategy explanation of this. First of all, as the name depicts, it is the HOW, that is the high of the week, and LOW, that is the low of the week strategy. Or alternatively, you can name this strategy as the big banks strategy. Now, this strategy starts if you use 30 minutes time frame and 30 minutes time frame, and you start with the market opening on Sunday, and this strategy ends up on the Friday close. So when the market open on Monday, so this is a hypothetical graph which I've chosen from one of the trade in the past, just to explain you where the market is going to make the low of the market and where the market is going to make the high of the market and the week. So coming over to this, if the market opens, if it is in a clearly bullish trend, I forgot to tell you one thing that's most important, that this strategy works only when the market has got a very clear trend, either it's in a bullish trend or it is in a bearish trend. If the previous weeks the market has been in a sideways, it opens up, it moves up, it comes down and almost closes near the close open of the market, that means the market is a sideways. In that way, you want to be able to use this strategy. This strategy, the most important thing is the market has a very clear trend. Either it's a buy trend or it's a bear trend. So market is either in a selling mode or in a buy mode. So we start with this. You have to use the 30 minutes candle, and the market opens on Sunday, the market opens, it moves up the open price. So from here you can draw a line of the market open till the end of the market. This line will help you. Now the market is open and moves a few pips up, then start falling down. And it made a low. Again market moves towards the market open and it moves few pips up, then it starts falling down. So the most important thing is, in 20% of the cases, the market is going to make the low on on Monday. But I will not suggest that you should take the trade on Monday, because market may come and retest this level and break this level and make a new low. So the most important of this strategy is that the market is generally making low between the Tuesday Euro session to the Wednesday US session open. So market is going to make the low or the high of the week between these two sessions. I repeat once again, the market is going to make its low or a high on the Tuesday Euro open or Wednesday US session open. In between this, the market will make its low or the high. So accordingly, if the market make a low on Monday, so avoid trading on this. However, if some intraday trader, they want to take some of the trade, so you can make the entry from the low of the Monday till the opening price of the week, and then take out the profit and exit the trade and wait for the market low for the week. So as I've already told you that the market is going to make its low on the Tuesday Euro open to Wednesday US session open, market is going to make low. So whenever in these timing the market makes a new low, you can put the trade and wait till the weekend where the market moves, and likely chances that you are going to win many pips per trade. Now, second important thing is that market setups is in the form of W's in case of lows. Market make a W. There are three types of W I have given. One is the W with the level, with the same level. The other W is having a one wing slightly up, and another type of which is the extended W, it's one wing slightly low than the previous low. So these three W's are very important to really generating a setup to enter the trade. Now, if the market make such type of W formation between these two sessions, that means the Euro session on Tuesday and the US session on Wednesday, in between, if the market makes such W formations and makes a new low, so you can enter the trade and you can earn a lot of money. Now, what generally the take profit limit would be? As I've already told you that the TPs and SL should be around 30 to 35 pips for those pairs having general volatility between 220 to 250, 60 pips, and 45 to 50 pips stop loss for those pairs having volatility above 290 to about 320 pips per week. So your TPs would be generally from 220 pips to about 280 pips per trade. Now in this trade, in this setup, the recommended would be that you take 2% risk per trade of your capital. If you have a capital of $100, so you can only risk $2 per trade. Now, how many trades you can take per week by utilizing this strategy? So I would suggest that you should take 5 to 7 trades, not more than 7 trades in a week, because the market may move abruptly in any of the catastrophic situation and may hit your stop losses. So I would not recommend that you're going to take 7 trades or more than that. Advisable is that you must take 5 trades to 7 trades in a week so that you can earn a handsome profit. Because per trade TP is around 220 to 280 pips, and you can earn about 800 to 1000 pips in a week by using this strategy, which is used by the big banks in the world. Now, second thing, I have explained all the strategy for the low of the week, but the same setup stands for the high of the week as well. If the market is bearish, so it's gonna move up first and then it can come down. So if the market start moving up after the market opens, so particularly in the bearish days, then it will form 3 M's. These 3 M's are very important. They may have a different shape. One M having these 2 levels same. The other M is, the left one is up, having a higher than the right one. The right one is a bit below than that. And the third M could be an extended M, that may be that it crosses the high of the previous and then start falling. In case of the low of the week, you have to consider the 3 W's. In case of the high of the market, you have to consider the 3 M structure so that you can enter the best stride possible. If you have any other questions regarding the strategy, so you can share your comments with me. And if you want that I should keep on giving you the good videos about the Forex structures, Forex strategies in the next time in the future, so I would expect that you would subscribe my channel, you will give liking, and as well as you will press the bell icon so that you will be updated with the new upcoming videos of mine. And all those traders who have lost their account before that and they won't be able to earn a lot of money from this, or they may be kept on losing their account, kept on washing their accounts, you can utilize this strategy and you can earn a lot of money from this. All those people are really fed up of trading and they think that they cannot earn from the trading, so you can use this strategy on your demo account, and after that, after 1 month or so, then you can utilize the same strategy on your live account and you can earn a lot of profit.
So